7:02.
7:02.
Stephen is on The Money Show.
6 to 8 p.m.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, proud sponsor of the African Mining Indaba 2025. Good evening. I'm Stephen Grootes. Glad you're with us on The Money Show this evening. Still, of course, the attention is really all about the new US President, Donald Trump, and a sort of sense of, I don't know, suspension, anticipation, I know disbelief in some quarters, but about what is going to happen with trade policy and around tariffs. And that really is still the question. And that's what's driving international markets at the moment. Still no clarity really on what he's going to do. And I must just say, it seems to me entirely deliberate. This is the point. Just by saying you're going to do something, you can get someone to do something. So say, for example, you're the finance minister in a country like, I don't know, South Africa, and Trump is threatening tariffs against members of the BRICS nations if they push harder for new reserve currency. Well, maybe you will just take your foot off that pedal a little bit. It can be quite subtle. And I wonder if what we're seeing is really a kind of exercise in performance, which is really pushing political action. Either way, it's hard to know how effective it is going to be. In the meantime, of course, the problem for you if you're making decisions in a business is what do you do? Do you invest in that plant that is going to rely heavily and tie you up in sort of foreign exchange earnings for quite some time? Is that what's going to happen? Are you going to make that decision, or are you actually just going to wait for quite some time and wait to see what happens? In which case, how long do you wait for? And that really is one of the fundamental problems that I think people are actually going to have at the moment. To put it all another way, it is really never wise to create instability in terms of investors. It's the old slogan. What investors want, what business people want, is stability. And Trump himself essentially seems to be stopping that stability. That's one of the major issues. 011 883 0702 021 446 0567.
The Money Show on 7:02.
Monday to Friday, 6 to 8 p.m.
Well, it's now 23 hours and 49 minutes since Donald Trump was inaugurated for a second term as US president. And the economic policy he's going to follow, still not entirely clear. In various remarks at different times over the last day, he said he'll institute tariffs of 25% against Mexico and Canada from the 1st of February. In a conversation about Spanish defense spending, he appeared to say he would institute tariffs against the BRICS nations if they continue to do certain things. That would include us, of course. And then in energy policy, he's declared an emergency that would remove environmental protection and allow much more drilling for oil and fracking in the US. We have a variety of voices for you this evening. First, Dr. Azar Jammine, Director and Chief Economist at Econometrix. Azar, good evening. It's still very difficult to get any kind of clear picture about what Trump is going to do. I presume the big variable is tariffs, and we probably won't get some clarity for some time.
You're absolutely correct, Stephen. There's a huge degree of uncertainty. But it isn't only in tariffs. The tariffs is a key factor. Trump is supposedly trying to reverse a massive U.S. trade deficit. But in the process, the very threat of imposition of tariffs has already done a lot of the work to unwind the benefit that he could derive from increasing tariffs. The dollar has risen by between 7 and 10% ever since it became probable that Trump would win the U.S. presidential election. And that in itself has neutralized a lot of the benefit in terms of increased competitiveness for U.S. goods on foreign markets.
So far, he hasn't really threatened South Africa directly. Presumably, if he imposes tariffs on other countries, that would still affect us. To put it another way, tariffs against Mexico and Canada, if they were announced, I presume would impact the rand almost immediately.
It would, in sympathy with the Canadian dollar and the Mexican peso, but more generally, the big fear is that this would generate a huge increase in retaliatory tariffs being imposed by other countries, and that in the process that would escalate inflation around the world and cause a reversal of the big gains from globalization that the world economy has made over the last 4 decades.
One of the big factors of the moment is that global capital, if it can move, is going into the US because that economy has been growing so strongly. that's probably going to continue unless he goes and imposes extreme tariffs.
That is correct, but as I say, a lot will depend on the retaliatory measures taken by other countries. And one of the big ones, of course, being China that we haven't mentioned. The big three for the United States are China, Mexico, and Canada. Between the three of them, they account for around 60-70% of all U.S. trade. One must bear in mind, though, that the U.S. is less vulnerable than many other countries because trade forms a much smaller proportion of its overall GDP than is the case with most of the rest of the world. The U.S. is substantially more self-sufficient than most countries.
Dr. Azar Jammine, really appreciate the time tonight. Thank you, Director, Chief Economist at Econometrix. Joined now by Sifiso Skenjana, Economist and Managing Director at ESG Analytics. Sifiso, good evening. Good to have you on the Money Show. The real issue is uncertainty. Trump keeps hinting at tariffs against us, doesn't and won't, I think, deliberately say anything concrete. Should we be changing any of our policies to avoid a possible tariff?
Good evening, Stephen. I think we've already seen, comments from our Governor, Kganyago, simply in essence suggesting that, the Trumponomics that we're seeing right now are probably going to slow down their own modeling and their own thinking around the deflation that we have been seeing, the price modeling that we've been seeing from a price point of view. And so we're going to start seeing the Reserve Bank pricing in higher increases from an inflationary point of view. And I think that's probably then going to inform a lot of the things in terms of what happens locally from a price point of view. And so how that kind of, trickle economics work in the context of our economy, of course, one from a currency point of view. Despite South Africa actually having outperformed a lot of the emerging market currencies, including, the Swiss franc and a couple of other euro as well over the period in 2024. What we often hear or see in the market is that dollar smile, Stephen, where in essence money moves to the US in good times and bad times, and so in essence you see a little bit of that movement away in terms of risk off from an emerging market point of view. When that happens, of course, we know that our currency is the 19th most traded in the world. We are a price taker, and particularly also oil prices account for 25% of the variation of our inflation. And so as soon as a weakened currency perspective, it might impact, what we see from an inflation point of view. And I think that's probably going to be probably one of the biggest policy pressure points from a South African point of view.
It could also be quite nuanced. I mean, Trump announced an emergency yesterday that will allow environmental safeguards to be removed. In other words, the US is probably about to produce a lot more oil, already the biggest oil producer in the world. So what the US might taketh with the US dollar, it might giveth with the oil price.
No, absolutely. Drill, baby, drill. Right, and I mean, and I think during his campaign he had alluded to that, and of course that also translates into the position they've taken around again coming off the Paris Accord. It's going to be quite interesting because on the one side, the drill baby drill agenda creates less pressure from a South African point of view in terms of the just energy transition. The noise becomes that side, and we aren't pressured, I think, at an economic level to accelerate our transition from high carbon minerals or energy sources like coal. And so I think that might be a nice reprieve for a lot of companies who are still looking at diversifying their portfolios, like the Exaros, etc. And that's on the one side. But on the other side, I mean, we've got massive reserves from, a lot of the critical minerals that are going to be, seeing massive growth in demand as we're seeing this green transition, manganese, nickel, cobalt. And these are all the things that are becoming quite interesting. South Africa, I think, is the largest actually got reserves from a manganese point of view. And we currently have about 37% of global production. And so these are the things I think that this kind of narrative around drill, baby, drill. On the one side, we've got some buffers in terms of demand for some of our minerals, but also it will slow the pressure from a coal pressure point in terms of accelerated transition. But of course, as we said, then there's the pressure point that it may have on the currency. And so it will really be an interesting one to watch and see.
I suppose for some companies to make decisions right now might be very difficult. I mean, is there a risk, not just here, but maybe in many, many other places, companies are going to hold off making decisions to see what Trump is going to do? And you're not really going to know what he's going to do until he does it.
Geez, Stephen, I mean, we've just come from an election year where companies weren't doing anything, so we don't need any more of that. No, I mean, I think it depends. It's probably sector specific. I think we've seen in the US, for example, a lot of the companies, big banks have come out of their own signatory in terms of one of the big ESG bodies there. And so climate financing, I think, is going to take its own shape and form. And I think all the banks are running their own strategies now. They're not letting it be nationally run as an agenda. And so I think from a banking point of view and fossil fuel financing and all of those things, I think there's probably less pressure in terms of the big banks. So they're probably now risk on again in terms of fossil fuel financing. If you're thinking about, some of the trading partners that, for example, are going to be exposed, Canada, particularly from an automotive point of view. I mean, Trump has spoken specifically around this being a budget balance issue in essence. So say it's the budget deficit they have, or the trade deficit they have on the back of their trading with Canada must in essence be erased. And so it's not really economics insofar as understanding, why this, is creating noise around us. And so I think, from an automotive point of view, there is definitely a view around that if Europe, who's got 2030, 2035 goals around electric vehicles, it means that it's probably going to shift in the market and say, okay, Europe's not buying our cars, but the US might, or the rest of Africa who don't have as pressured in terms of decarbonization journeys. And so these are some of the things I think that are sector specific, but I think the decisions themselves could be very meaningful.
Sifiso Skenjana, really appreciate it. Thank you. Economist and Managing Director at ESG Analytics. Handre Retief is Portfolio Manager at Novare Holdings, watching the situation coming out of Washington, D.C. very closely. Handre, good evening to you. We can see that this is going to be difficult for governments around the world to navigate. You're trying to create industrial policy at a time of great uncertainty. How should our government be dealing with this? What do they need to look for?
Good evening, Stephen. I think just from our government side of point of view, it's quite difficult to make large changes without knowing what's going on first. I mean, top of mind for us is obviously China and what's going to happen there. I mean, we've been quite happy that the first day hasn't been quite China-specific. We feel that the phone call that President Trump and President Xi Jinping had was quite constructive. So we actually think that on a net positive, we're on a net positive pathway at the moment where we think that our government should take just a wait-and-see approach. We don't think we should choose sides at the moment. So we think it's constructive. We're happy with the way it's going at the moment.
I do wonder if a sort of America First policy can find itself being replicated by other politicians in other places, America first, China first, Mexico first, Mzansi first, Handre. I mean, could we enter an era where this is how people do politics? They all sort of champion a kind of tariff-based agenda, which would have dire implications if it happened here.
Yeah, I completely agree. I think we could see that more. We're seeing more onshore, obviously, in the US. That's the name of the game, is deglobalization and onshoring at the moment. And with that onshoring, we're seeing a consumption boom at the moment in US. You've seen proper big companies like Taiwan Semiconductor that's been forced to not necessarily forced, but incentivized to move production to their local country, to America. So I think we can see that more and more globally where people are trying to get jobs locally. And it makes sense, obviously, because it makes sense out of economic growth, point of growth, but it doesn't make sense out of an inflation point of view, especially not if you try and do everything at once. We think that can be quite inflationary. So we're hoping for a middle way where Donald Trump and the rest of the world says, hey, we listen, we want to get some jobs back locally. We want to get some production locally, but we need to do it in a responsible way.
We're chair of the G20 this year. Do we have an obligation to use that to fly the flag for international trade?
I think we do. I think we're on a good footing. I think if you look in South Africa in the absolute, I think we're on our way to hopefully do about just under 2% growth for this year. I think there's some more consistent production, more consistent energy production. We just think transit is still a bit of a problem. But I think that you can navigate that. And I think once you have the story and you have the philosophy, the rest of the countries tend to hop on board quite easily. So quite optimistic about that.
Handre Retief, thank you very much indeed. Portfolio manager at Novare Holdings. All right, well, different views, of course, different insights into the situation around the US. Your view on what's going to happen, please. 011 883 0702 021 446 0567. I think there was an extra 6 there somewhere. And voice notes this evening on 072 702 1702.
The Money Show.
The market.
Anthony Modasani, senior equity sales trader at Absa CIB. Anthony, good evening. Thanks for coming in. All right, let's look domestically, shall we? First rand up, and that seems to be because of news out of the UK.
First rand down, Zanzi first, definitely. So first rand, I beg your pardon. First rand was up 2 and a bit percent today. There were headlines out of the UK that Chancellor Rachel Reeves on Monday launched a bid to shield the car loan providers from these multi-billion pound payouts. So the UK government's just a bit concerned that the massive compensation payouts could deter investment and harm Britain's reputation as a business-friendly destination. So First Rand has put provisions in because they have exposure via their Motor Nova business there. They have a provision of about 3 and a bit billion. It seems like the market was quite encouraged by that news that came out today.
Clicks, I mean, this is a company that people really, it's been a sort of investor darling for quite a while. Yeah. They had their first 20 weeks of their financial year up until halfway through January. The market didn't seem to be really moved by it. In fact, they were down on the day. Yeah,
Stephen, we were quite surprised by it. I mean, overall group turnover was up 8 and a bit percent. I think the market was looking for slightly more, so between 10 and 12%, and maybe just a little bit of a disappointment there. But there was nothing really glaringly obvious to get upset about. I think, like you said, a stellar performance in 2024. It was up 15 and a bit. So you're probably finding that there's just a bit of profit taking. Rather wait for the full year results to come out and then maybe take it from there.
They've got a lot of new branches coming. They've got more licenses. I mean, this is a group that's still growing.
Yes, 100%. And the UPD business continues to do well. And it looks like if that momentum continues to come through, then I think that'll give investors more confidence.
Got a couple of other important numbers coming through that will really tell us a bit about the consumer section of the economy, particularly over the Christmas period. Mr. Price tomorrow?
Yes, so we've got Mr. Price giving us an update, and I think what's going to be exciting about these updates, why the investor community gets quite excited, is that you've got these numbers include your Black Friday as well as your Christmas sales figures, So, and if you think about that, we've got two-pot money coming into the system, and then just quite a friendly consumer sentiment environment, right? You had inflation lower than expected, rates have come off a little bit, there's still that GNU euphoria coming around. So, it's going to be quite interesting to see how well these retailers do over this period. But, the sector has re-rated quite a bit. So, I think it's quite a high hurdle rate for investors to continue to buy into this at this point in time.
We've got Foschini and Woolies later this week as well. And I mean, yes. Woolies in some markets, you drive through Plet over the Christmas period.
Exactly.
It's unbelievable.
Yeah. Even the Nicolay branch was pretty busy over the festive period. So I think we're quite excited to see. I think the only concern is probably the Country Road division that might soften a bit. But, I think fashion, beauty and home will do well. And I think food, that should also perform pretty well.
MTN's really been on a good run over the last little while. They're up 5% today. News around regulations and prices that they're allowed to charge in Nigeria. Suddenly, Nigeria's been a problem for them in some ways, but suddenly there's a little bit of good news coming through.
Yeah, it's they've muscled through some very difficult times, but they seem to be navigating it quite nicely. So the Nigerian Communication Commission approved a 50% tariff increase to all the Nigerian telcos there. The news started coming out last week. You heard talks about it. Most of the telcos operators pushed for a 100% tariff increase, but NCC decided to go for 50% just to balance consumer protection and industry stability there. So I think that's quite positive for Nigeria, or for MTN Nigeria, which feeds back into MTN Group over here.
So, I mean, that's good for them. And now, obviously, the big variable, I suppose, will still be the currency. I mean, there's been this buzz around them for a little while. Their prices went up last week. Could this be the end of this momentum? Now we know what the figure will be.
Yeah, 100%. And I think, if you just look at MTN Nigeria, it's going to be really positive from an earnings perspective from them. In terms of the currency, I think the central bank is still largely involved in the market, just keeping things pretty stable there. Time will tell, but I think you're getting a lot of rather positive murmurs coming through, which will be positive for the stock in the near term.
Anthony Modasani, good to see you. Thank you. Senior equity sales trader at Absa CIB. More on the Nigeria MTN story. Dobeg, part of the telecoms analyst at Africa Analysis. He'll be on your radio after 7 o'clock just to give you a bit more information about that. Also, Nigeria in the news in many different ways at the moment, partly also because it formally and officially joined BRICS over the weekend. I wonder how that went down with the president-elect in the United States hours before his inauguration. But of course, the question then is, will Nigeria's admission change the economic nature of BRICS in some ways? We'll talk more about that as well on The Money Show, where the time has just gone 6:30.
The Money Show
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
20 minutes now to 7 the time. Good to hear from you this evening on 011 883 0702 and 021 446 0567. So many questions still around Trump. We'll try and sort of turn the conversation around a little bit. We'll focus on the conversations that we're hearing in Davos at the World Economic Forum, and of course just get a view from there. I'm sure that Trump is the sort of talk of that particular village, but there are other questions around globalization, around tariffs, also simply around some of what's been happening in South Africa too. And then don't forget a little bit more about Nigeria, their decision to allow telecoms operators to increase their tariffs by 50%. I mean, imagine trying to run a company where your revenue stays roughly the same for such a long period of time, 10 years in this case, your revenue per customer at least. And as a result of that, one presumes that your costs will be going up, and there's very little you can do about it. Until today, that is, when the regulator there said that, yes, they could increase their tariffs by 50%. The industry did want 100%. Also, I suppose tonight, several questions, of course, around BRICS and how that is going to function and if it is going to change its nature at all in light of the election of Donald Trump and his inauguration as president yesterday. I would imagine one of the big factors really is going to be what Beijing does, and this perhaps is the key dynamic going forward, just to see how that all plays out. And of course, we don't really know what is going to happen, because at this stage, we don't know what Trump is going to be doing. Well, those are some of the questions that we're going to be looking at over the next little while. And of course, we'll try and get clarity for you on them as we go forward.
WhatsApp Stephen
On 072
702
1702.
Well, plenty, of course, to talk about this evening. I'm sure you've seen the billboards for the insurance company Naked, where we'll be speaking to one of their co-founders in a moment. A very different sort of model of doing insurance. I don't know how much time you've spent on the line talking to insurance companies. I can tell you, based on recent experience, it really does help to shop around. You might be surprised at what you actually find. But it does seem to me that if you look at the amount of competition, it's an incredible amount of competition in the insurance industry, just to kind of get market share at this particular moment might be quite a difficult thing to do. I don't know if we've ever seen an industry, particularly around car insurance, that's really seen so much advertising and so many people, in a way, trying to get into the market all at once. And it's been like this for quite some time. Very interesting to watch. Just gone 6:45.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
Well, if the World Economic Forum meetings are supposed to be the meeting place of international business and financial ministers and central bank governors, and Davos is supposed to be the ultimate symbol of an international world and international trade, you can probably imagine how cold those snowy streets are feeling today. Donald Trump is back in the White House, and it would seem threatening tariffs left, right and centre. Of course, we have several business leaders there and a big government delegation along with President Cyril Ramaphosa. Well, one of the people there representing South African business is the CEO of Investec SA, Kumesh Mudlai. Kumesh, good evening to you and thank you for taking the time. I know it's very busy there. I suppose in a kinder world, given the changes we've seen in South Africa and our coalition government, we could have been one of the big stories of Davos, but imagine Trump is overshadowing everything.
Evening, Stephen. Funny enough, I think South Africa is still holding a really strong role here today. In fact, we've just come out of a talk by the President addressing the World Economic Forum, hosted by the President of the World Economic Forum, Professor Charles Schwab. So I think, notwithstanding all of that, the South African story is still flying and strong in many ways. And really, I think what the President did today in addressing the broad forum was really positioning and linking the World Economic Forum to SA chairing and hosting the G20 in 2025, and drawing that important link about business, civil society, and government working together for the greater good, and not just from a South African perspective, but more from a global perspective. But you're absolutely right that in the last, obviously following the inauguration yesterday, the rapid-fire presidential edicts that were issued in the White House last night, that certainly has dominated some of the discussion. But what I'm proud to say is that South Africa is flying its flag.
I mean, in some ways, we've kind of gone against much of what's happened in the rest of the world. There's a political division in many places. We have a coalition government.
Very much so. And I think our president very articulately put that position forward, that it took us a month to pull together a GNU when in many more mature democracies it's taken over a year to do so. So I think from that perspective, we have a compelling narrative at that, just from a political perspective. And then also I think from an economic and growth perspective, the opportunities that potentially South Africa and the rest of the continent can offer the global world an insight into what could be in some respects, but also a real investment destination for us.
Trying to make an impact in a place like Davos when so much global capital is going to the US, you say clearly we are having an impact, but is it quite difficult to attract some of that capital here to sort of just get above all of the noise? I mean, and I suppose there's quite a lot of historical interest in South Africa and maybe even some curiosity about how we've done things so differently to everyone else.
Very much so. So I think the global conversation, and this is where I think we really have to, as a South African broad civil coalition and society and business, we really need to realize that we have to lift the level of our current debate in so many ways. In a world that's becoming a lot more potentially isolationist, higher levels of protectionism and rising nationalism, the South African narrative has to be very compelling to win global capital. It's really has to be a narrative around that we can really offer a good return on a number of levels, one on an economic level and on a social impact level, as well as an environmental impact level. So I think all three of those threads have to come together. And that is, again, some of what the President articulated. But I think if I had to speak to a broad South African audience, the key message has to be that our debate has to get to another level. We're competing in a world where capital moves very quickly. Capital is an extremely scarce resource. And some of the minor debates that we often get caught at the fringes of as South Africans is where we really have to step up to the next level.
You're one of the companies that's been working with government. There are many companies working with government, but you're one of them to deal with some of our logistics problems. We're on, I think, day 301 with no load shedding. Are you expecting more progress from that partnership to come? Some of these big problems that we're dealing with, that we've been dealing with for a little while, are you expecting some progress to come?
I really am, Stephen. I think, what's been highlighted has been how successful the collaboration between government, business, broader civil society, as well as the labour and trade union movement is concerned. It almost creates a different operating model for the country, that you can see all these sectors coming together potentially for the greater good. If we look at the further challenges we have to tackle, You've got a water crisis that's looming. And our estimates are that we have to spend close to 100 billion rand a year to over the next 10 years to build the right infrastructure, to make sure that we're maintaining infrastructure in the right way. That's a significant number. Similarly, we have to look at how the transmission and distribution network for electricity has to come into the next level of efficiency to distribute from areas that previously would not necessarily have been grid power points, in other words, points that we would have plugged in from areas like the Northern Cape. Historically, a lot of our grid and transmission distribution support network has been built in areas where our coal mines and coal-fired power stations are. But when you're talking to renewable energies, and I'm using just the example of the Northern Cape, you've got to look at how do we build that grid support network. Similarly, if I turn to ports and rail, all of that has to be done over the coming period of time. And we look at those initiatives and say, through those 3 or 4 key threads of infrastructure, and this is key economically productive infrastructure that we're talking about, infrastructure that leads to growth, that leads to, in my view, inclusive growth if we get it right. So ensuring that we're building broader employment, broader casting of the social net, and more inclusion in the economy, which is key. These economically productive assets do that. The opportunity to leverage private capital, broader development finance capital to on public-private partnerships in this massive infrastructure build that would be required over the next 5 to 10 years. And some of it's obviously very immediate, and we think that over the next 2 to 3 years, that number could be between 700 and 800 billion rand.
Kumesh, thank you very much indeed.
That would be needed.
Large numbers there. Kumesh Mudla is the CEO at Investec SA. Kumesh, thank you. Really appreciate that. Of course, from Davos with the World Economic Forum.
You're listening to The Money Show with Stephen Grootes, brought to you by Absa Corporate and Investment Banking, proud sponsor of the African Mining Indaba 2025.
The insurance company Naked, I'm sure you've seen their billboards around. They say they've now received more than 700 million rand from a group of international investors in its latest funding round. The company essentially is using AI to deal with claims without you having to speak to a call center agent. It's probably the future of insurance until, of course, something goes very wrong or the situation is very complicated or the machine just won't listen to you. Alex Thomson is a co-founder of Naked Insurance. Alex, good evening. You've got another 700 million rand in funding. Quite a lot of it comes from people who've invested in you already. Clearly, they're feeling quite confident about your product.
Thanks very much, Stephen. Yeah, great to be here. And yeah, we're very happy about this announcement and about this funding round. And yes, I mean, I think, it's worth saying that it's not only international investors. We've had great support from some of our local investors, including Hollard and Hollard and Yellowwoods and so on, as well as many of the international investors that have been with us for some time.
Insurance is intensely competitive at the moment. You have billboards everywhere. So does everyone else. Is it really possible to grow market share in this kind of environment?
My founder and I, when we started this, we recognized that in South Africa, we've got a very capable insurance market. And we certainly didn't start this to just add another one into the mix. We felt that there was going to be a significant shift in the way that insurance was going to work. And as you mentioned earlier, I think the use of technology and AI was going to play a big part of that. And I think the milestone we've reached today, I think, reflects the fact that this shift in the industry is in fact happening. So we see ourselves really as a new generation, even like a new category of insurance. And we see a lot of potential as things develop to build a significant market position. I would just like to maybe clarify one thing about what you said earlier. I completely agree. You can't rely 100% on the machine to deal with insurance. And we certainly do have people who are very, very much involved in the insurance and in the claims process.
Okay. Now, I was wondering about that. I mean, in the end, I would imagine you want to get to a point where most of your communication, most of your claims are dealt with without a human being. That's kind of what the AI is for.
Yes, I think the way we look at it is that, the way in which many, many people are dealing with many other parts of their lives, whether it's taxis or hotels or various subscription services that we're all using these days. We think that there's no reason that insurance can't operate just like that. Okay. And so our job, and where we bring in all the AI, is to try to put the control into the customer's hands so that they can decide what they want, and that we got to make it as simple and as clear. And then we've got to do all the sort of hard stuff in the background so that the customer feels in control and can really understand what is happening. But yes, in insurance, if you look at certain claims, they can get very complicated. And I don't think we really expect to fully, automate that. We just think that there's a lot that can be done to make it faster, to make it easier, and yes, to take cost out and offer better prices.
You have a relationship, and it seems like quite a close relationship, with Hollard Specialist Insurance. How does that work?
Hollard has been a partner of ours from the early days, right from when we started. They were an early investor in the business, and they've been incredibly supportive in getting us to where we are today. And, I think the transition we're going through now is one where we're really standing on our own 2 feet, in a very independent way. But we still underwrite on this license that you mentioned, which is within the Hollard Group. And we still sort of have that guarantee that from the big group, so although we kind of, we knew and we bring all this new stuff, there is still, that size and that reputation and that backing that a group like Hollard brings.
Do you see insurance as an industry? You clearly see it changing quite dramatically. We're clearly still in the middle of that change, but other people are obviously going to use your business model as well. Are we going to end up having a sort of battle of AI interfaces in insurance? Is that going to sort of define insurance in 10 years' time?
On the one hand, yes, we've already seen a lot of people, often quite flagrantly copying what we've done. I think the advantage that we bring, Stephen, is that when we started, we had this view of the world in mind. So when we built the systems, which we did all ourselves, with a local team, we really were trying to build something that would be able to take advantage of these developments as effectively as possible. So what that boils down to, is that when we are trying to use machine learning or AI to automate something, to make something work better, it's just so much easier for us, so much cheaper than it would be for an insurer that's maybe been around for a long time and has very old systems and products and distribution that's just a lot more difficult to make work with some of these developments.
Sure, it's an online news site competing with someone that still owns newspapers. That would sort of make a lot of sense to me. Is there a lot of growth in the market, though? People we know have been through a very tough time. Incomes have been stationary or going down for quite some time, beginning to maybe move up a little bit. Insurance is something you absolutely have to have, except you don't absolutely have to have it sometimes. And I don't know if the market is going to grow as quickly as you would like it to, or I don't know, maybe need it to.
A big part of what we're trying to do is to expand access to insurance. And I think one of the big advantages of using a very modern technology platform is that, the costs to us of adding additional customer and, from a technology perspective are really quite low. So the amount that, like with traditional insurance, when somebody's only going to pay them, 100 Rand a month or something like that, it's very difficult for them to make it work because there's so many costs that they've got to build in there. That doesn't apply to us. So what it means is we can offer, insurance at lower price points to lower income customers and offer a product that previously just wasn't affordable to a lot of people. So I think your comment is probably, broadly true in the sort of more affluent part of the market. But we're certainly seeing a lot of interest in the lower end of the market. And, if one can get that right, we think there's massive potential for growth, in the industry overall.
Thank you very much indeed. Really appreciate the time. Alex Thomson is the co-founder of Naked Insurance. We'll focus a bit more on Nigeria, telecoms and BRICS. And don't forget personal finance with Warren Ingram. You're with The Money Show.
And now, The Money Show.
With Stephen Grootes on 702
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, proud sponsor of the African Mining Indaba 2025. Good evening. Welcome to the second hour. Well, important developments out of Nigeria that really could have a big impact on the telecommunications industry this evening. And then also Nigeria officially joining BRICS over the weekend at a time when we know that the current administration in Washington, D.C. is very hostile to the whole idea of BRICS. We will talk a bit more about that. Don't forget also, we'll speak to Rotendo Hundengwi and just get an update on what's happening on our continent. And then, of course, personal finance this evening, how to maximize investment growth. If you're starting, good time to start, beginning of the year. How to actually, over time, make sure you get more, I suppose, bang for your buck might be the best way to put it. Lines open, of course. Good to hear from you this evening on 011 883 0702 and 021 446 0567.
702 with Stephen Grootes.
Email him on stephen@702.co.za.
Well, MTN shares up by over 5% today. The Nigerian government finally confirming it will allow telecommunications companies to charge more for phone calls for the first time in over 10 years. Nigeria saying operators can increase their tariffs by 50%. Operators had asked to increase their tariffs by 100%, to double them. Dobek Pata is a telecommunications analyst or telecoms analyst at Africa Analysis. Dobek, good evening to you. 10 years since the last increase. I imagine operators have been needing an increase for quite some time.
Good evening, Stephen, and to the listeners. Yes, they have, and I think for two reasons. One is the historical reason is that there was quite a bit of price competition in Nigeria in the, let's say, earlier days of mobile communications, maybe over 10 years ago. And that led to a downward spiral of prices. And then, as you indicated, over the past 10 years plus, those prices haven't increased. So they're already starting from a relatively low level compared to South Africa, certainly. But the second reason why operators would certainly want to increase those are the economic factors that they have to negotiate through in the country. And that's, number one, that's a very significant depreciation of the Naira, the local currency, against the USD, but also the Rand and other major currencies, and also an inflation that has been increasing. And over the past 2.5 years, roughly, it's doubled to currently about 35%. So you can imagine all costs around you are going up, some quite significantly, that you need to contend with as an operator and a service provider. But you cannot increase tariffs for the services you charge, so you're really just relying on increasing your customer base, which also has been facing a bit of headwind because of augmented regulations regarding the equivalent of RICA, etc., which meant that MTN had to, and other operators as well, had to clean up the database, take some of the subscribers or SIM cards off the services, and then subsequently try and regain them with the proper documentation.
So, I mean, their costs, as you say, will have gone up quite dramatically over so much time, devaluation in particular. A 50% increase, I mean, will they now be making a regular profit, do you think? I mean, obviously they wanted more than that.
Correct, yeah, well, they wanted twice as much, 100% as you indicated. So it certainly will put them in much better stead. I'm not sure about regular profit, but certainly I think returning to a semblance of profitability and increasing revenues, certainly. I mean, the revenues have been increasing in local currency, but when you try to expatriate that money back into the group, for instance, as MTN would, or you need to use that money to purchase import equipment to keep building out, expanding your network, improving your network, which, by the way, the National Regulatory Authority, the Nigerian Communications Commission, also is increasing or introducing more rigor into quality of service of the metrics of those services. So they require the operators to invest more to provide better quality services. But now you can only buy 30 cents for every dollar you used to be able to buy several years ago. And effectively all of the equipment that you need for that network to build that network and improve it is denominated in US dollars. So, very tough environment, but it's getting onto the right or better path, let's say, as far as increasing revenues and back into profitability.
Dobek Partap, thank you very much indeed. Telecoms analyst at Africa Analysis. Really appreciate the time. Well, let's stay in Nigeria. Confirmation over the weekend. Nigeria fully and formally joining BRICS after first being an associate member. Professor David Muniai is an international relations and foreign policy expert. David, good evening. Nice to talk to you on The Money Show. Nigeria is the fourth African country to join BRICS, along with Egypt, Ethiopia and ourselves. It has a large population. Is the nature of BRICS changing with more countries from our continent?
Well, indeed. I think what we are seeing is the expansion, and my own prediction is that it will go beyond the global south, including some of the countries in the global north. Because at the end of the day, BRICS is not an ideological forum. It all has to do with the change of the current international order, the demands that are made by the developing countries. And therefore, I think in that equation, Nigeria is quite critical, not only for Africa, but for the whole world. By 2050, it will have one of the largest population within a top 5.
Nigeria says it's looking forward to more trade opportunities. Obviously, I presume, like many other countries, it might like more access, say, to Chinese markets, maybe Indian markets. We've had quite a complicated relationship with Nigeria sometimes. Does membership of BRICS automatically lead to more trade for countries that join BRICS?
Oh, indeed. I think it's the closeness and a frequent interaction of the head of states and government with these summits, and they go beyond BRICS. I think Nigeria also should be in G20, and at the United Nations General Assembly, I think BRICS countries do meet on the side, alongside some of these summits, to agree and have a common position on core issues affecting global peace and security. And in that context, I think it is in Nigeria's interest, the continent, and more importantly, it's also good for South Africa to be with Nigeria as it deals with some of the core issues affecting our continent.
Well, I mean, you talk about the global north and the current international order, which, as you say, is changing. Obviously, the US President Donald Trump doesn't like BRICS. He's been threatening to institute tariffs against BRICS nations. I mean, should the BRICS nations respond in any way, or should they just continue as they have been?
I think President Trump will find out quite soon that the ground has shifted at the world stage. The United States is still the strongest and powerful country, but I think with time, some of the major pillars of the U.S. power are being chipped. The U.S. dollar usage is going down. Alternative SWIFT for BRICS that is in making. The petrodollar, your Saudis, Iranians, and a number of other countries are now trading in other currencies, and the local currency usage among countries, it's increasing. And with that, I think in a gradual process, I think we'll see U.S. really losing its hegemonic power.
David, I know we asked you and invited you to speak about Nigeria, but I know, of course, that you're also an expert on China. We don't know exactly what Trump is going to do. We do know he had a conversation with President Xi last week. I presume, and the assumption for all of the conversations we've had on the Money Show about this, is that if Trump were to impose tariffs on Beijing, Beijing would respond, and probably in a proportionate way. Is that the right assumption? Is that what Beijing would do?
Yes, I think China, unlike the first Trump administration, I think that with the second administration, China is much more prepared. If you look at trade volumes, you'll see that the Chinese have been prepared for this by shifting their trade from U.S. and Western world more into the global South. And therefore, the leverage that the U.S. used to have on China, it's quite small and insignificant. And therefore, I think tariffs, it's a lose-lose kind of situation. And therefore, I think there'll be more negotiations. And the tone with the speech yesterday, it appears that he's back on his transactional kind of negotiations and pushing to ensure that U.S. big companies, as you see with big giants attending the inauguration, I think they need access to the Chinese markets. And therefore, I think that's what we're going to see. There will be tension, but it won't be as bad as the last time.
We don't know what's going to happen. We don't know how it's going to happen. It would seem that in the United States there might be a period of more division, particularly if you look at the tone of Trump's speech yesterday. China, as we know, likes to play a long-term game. They might be sitting back and thinking this over the longer term might be bad for the US, might strengthen the US in the short term, weaken them over the longer term, and that would be good for China.
Oh, indeed. It's a question of just letting Americans destroy their own power at the global level with less gunshots, so to speak.
Professor David Munyai, thank you very much indeed. Do appreciate it. International relations and foreign policy expert.
702. Stephen is on the Money Show.
6 to 8 p.m.
Time to find out what's been happening on our continent now. And of course, Dr. Rotendo Ndwingwi, Founding Director at Tribe Africa Advisory, is back in your studio. Rotendo, nice to see you. Good evening. In the Republic of Congo, I've got to get this right, it's a big river. The Republic of Congo, they're having a real energy transformation.
That is a very good evening to you, Stephen. And I think in between the whole Trump 2.0 and the World Economic Forum, Africa is going to be an interesting place, and G20 in the next few months. But coming home back to Africa, well, that's where we all believe and sit in. Congo, Brazzaville, and not to be mistaken with our traditional DRC, the Democratic Republic of Congo. It's got a population of 6 million. As a GDP, it's still small compared to the DRC, 15 billion, but it's a stable economy. But a lot of people don't know it. That little country is probably the third largest oil producer in Africa. And one of the big initiatives they've done just in terms of diversifying their economy and also strengthening and leveraging off their capability of oil and gas from the shores, because it's also a coastal country. There are sort of 4 key initiatives that they've put together, and all of these hop around a big conference they're having. It's an inaugural conference for energy in March, so they're quite excited about this. But there are sort of 4 key initiatives that perambulate around that. One is that they're trying to drive electrification. They've only got 12% electrification in the rural areas in the country. So that's a big initiative. As we know, Africa electrification at the moment, or energy, is probably accessible to only half of the 1.3 billion people. So Congo plays a small part in terms of providing that solution. They are driving legislation and licensing in terms of facilitating for multinational, international players to come and invest there. A lot of investment is also going around this conference, hence they're having it in terms of innovation. So in other words, how do we convert oil and gas that we're able to access from our land and seashores and drive it into the economy. And another key important point as well, Stephen, is that they're also looking from an ESG perspective in terms of saying we don't only want multinationals to come and invest in the country and get the benefits from the country, but at the same time, how can we develop the value chain all the way downstream? So for a small country with a year-on-year GDP of 2%, it's exciting, but it'd be also good to see in terms of how that also converts. But at the end of the day, I think it's a positive direction for Congo.
And I mean, obviously, the more energy you have, the more your economy is going to grow. I mean, it's just one follows the other. Look at some graphs around our economy, and it'll illustrate the question for you quite nicely.
Very true. Very true.
In Cote d'Ivoire, they're looking at climate change and economic transformation. How are they doing that?
So Cote d'Ivoire, the head office for the African Development Bank, obviously now called the Ivory Coast. Again, just another country as well that, Cote d'Ivoire is more popularly known, Stephen, with regards to cocoa production. It's probably the largest producer of cocoa in the world. So all the chocolates that you and I are trying to stop eating, we have to blame the guys in Cote d'Ivoire in terms of producing all that cocoa. But one of the key initiatives, the number of economic structural reforms that they've implemented in terms of setting them up, and they've been highlighted by the IMF with regards to these key initiatives. And it's quite important because they're actually playing quite a significant role with regards to driving the West African economy. Just to add some stats there, their GDP growth year on year is 6.4%, which is, I think, is on average 3% higher than their bordering countries. Their inflation has been kept stable to at about 2.2%. And the 3 or 4 key initiatives that they've done, focusing on diversifying the economy and focus structural economic programs. One is they've decided to keep domestic GDP spend on the low. The investment in infrastructure and education and health, which are key requirements for them to stimulate the economy and the well-being of their people, has been absolutely a priority. And in line with that, the IMF, because they've seen the investment that they've done and there's a focus with regards to climate change related activities, have injected about $1.3 million of investment in the region. So I think what just this talks to, Stephen, for me, is that if you look at Cote d'Ivoire in terms of where they are, what they want to achieve, and where they're located, it's just, again, is another good story of a country that is realizing that they have to fend for themselves. They have to diversify the economy from being focused on agriculture in itself and invest in other items. And the IMF has been actually happy in terms of the reforms that they're implementing and taking it forward. So that's another nice story to hear with regards to what's happening in West Africa. Take away the coup d'etats and all the fights that are happening from different regions. It's another good story to carry along.
And I mean, it's one of those stories where once you get that sort of economic flywheel going, once you get reforms, they build on themselves, and hopefully over time you get real momentum going.
No, you do. And one of the sort of key funds that's focused in terms of doing that, and that's why the IMF is actually playing a key role here, is that it's called the RSF. So that's the Resilience and Sustainability Facility. It's a big word, but at the end of the day, it's a fund that the IMF has created specifically to support countries that have got a focused strategy with regards to climate change programs for the well-being of the people, addressing SDGs and growing the economy. And Cote d'Ivoire, I don't know if maybe we can say because the Africa Development Bank is there and obviously they've got a lot of IP and intellectual capital that they can leverage off. Either way, it's contributing to them getting this funding and implementing those reforms that are actually having a positive impact with regards to the economy and where the nation is going.
There's a curious story about the Securities and Exchange Commission in Zambia, and it's sanctioning Standard Chartered. They've been in Zambia, I mean, forever, over the mis-selling of Chinese property bonds.
Sounds like a page out of the James Bond.
Well, when something gets this complicated, you know you've got to read the fine print.
Yeah, so the Zambia Security and Exchange Commission's the ZSE or ZECS obviously has fined Standard Chartered. It was an interesting story because, funny enough, I've talked about this before. Standard Chartered is strategically pulling out of Africa. It's pulling out of Zambia. It's pulled out of, I think, Uganda, Cameroon. It's pulled out of Tanzania, focusing more on the Middle East, and it's just in line with their global focus with regards to focusing on emerging markets that are probably giving them a better return on investment. I think the sad story here is that they are probably the oldest bank in Zambia. Stephen, they've been there for over 120 years. So there's a lot of investment. So when you find a player like that pulling out, it probably says a lot. But in this case, it looked like a funny story in the sense that it involves the Chinese, involves Zambia, it involves the UK bank. But apparently there was the mis-selling of some bonds from a Chinese company to a local a business entity in Zambia. And there were two key areas. It was material misinformation and some exclusionary clauses. So it looks all administrative. But I think what stuck out for me is that multinationals like Standard Chartered usually draw multinational investment from the UK, from first world countries. So it's said that they are pulling out. I don't think there's much more to read than that in the story other than that. It's just a transaction that has gone bad. They don't name, when you follow the story through, they don't name the local player. They just named the Chinese player. So it'll be interesting to see how that rolls out. But another interesting story just in terms of multinational movements on the continent.
And then in Morocco, a university, a high-tech university, they're taking on the Ivy League. How are they doing that?
Now, I was quite excited about this because, Africa, one of the big things I always talk about Africa, by 2050, that whole story of the demographic dividend. By 2050, 40% of the world's youth will be in Africa. We will have a population of 2.5 billion. So we'll have a lot of people here. And the big thing for Africa is to build skills that can allow them to tap into the global economy, but at the same time, building skills that actually can be applied on the continent. And Morocco has invested over 3.5 billion US dollars. They call it the UMP6 University. So the University of Mohammed VI Polytechnic. So the abbreviation is UM6P. What's exciting about it is, firstly, they're focusing on practical skills that they can equip students that are coming from, I think, about 40 different countries, Stephen, onto the African continent, from the different parts of the African continent. Over and above that, they're getting the best of minds, and they're getting faculty from all over the world. So they're collaborating with leading universities in the US, in Europe, in Asia, to come and equip these guys. The skills that the guys are being taught are innovative skills, but to address African problems in the agricultural sector, in the health sector. And so it talks to diversity. And as I said, there's a substantial amount of money that is input there. So when you follow the story through, Stephen, it's quite exciting, because they've intentionally said that we're going to make it the best. We're going to get the best from Africa. We're going to get the best from the world to come and equip these students and get them into the forefront. And just to scare you, because I learned this word today, and I was actually absolutely fascinated by it. They've invested in the most expensive and most powerful supercomputer on the African continent. It's called the African Supercomputing Center, and it's got a remarkable capacity of 3.15 petaflops. Now, to translate what 3.15 petaflops is, it means it's capable of performing over 3 million billion operations per second. And that's a asset that sits on the African continent and contributing to AI and technology. So it's not as smart as me, but it's interesting.
I bet it still can't tell me what Trump's going to do.
You never know. Give it time, Stephen. Give it time.
Dr. Rutendo Ndwingi, always good to see you. Thank you very much indeed. Founding Director at Tribe Africa Advisory, author of the book Rumble in the Jungle Reloaded. Was the anniversary of the original quite recently, I think, over the weekend, wasn't it? All right, Warren Ingram, how to maximize your money, personal finance. That's next to you with The Money Show. It's 7:30.
The Money Show
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
On the next Money Show, Donald Valoy, CEO and co-founder of Zilzi and South African grocery delivery startup, will join us as this week's shapeshifter. The startup, of course, survived COVID-19, still going strong. Then Business Unusual with Graham Codrington, the futurist and partner at Tomorrow Today. Your consumer ninja, Wendy Nola, will be in your corner fighting for your consumer rights. Also, analysis of all of the top breaking business stories of the day.
The Money Show.
Personal Finance with Warren Ingram.
Warren Ingram, of course, is a certified financial planner at Galileo Capital. How's it, Warren? Good to talk to you. Talking tonight about how to maximize your investment growth. I presume here we're talking about long-term strategy.
Exactly right, Stephen. I think, a lot of the time when we talk about investing and we talk to people about investing, they will be raving about the great return they had on whatever the investment flavor of the month is. The share that doubled in value over the last year, or the crypto coin, or whatever it is that. But you find when you speak to those people, 2 or 3 years later, very often the conversation's gone rather muted. Whatever that star performer was hasn't done so well, and often given back a lot of the growth that it had generated over a very short period of time. And I think when you speak to people who are not that familiar with investments, they're often quite cynical about markets and about investment growth, because they believe it's the system doesn't work for them. This investment thing works for some people, but surely not for them. And I think you're right. It's because there is a big lack of long-term focus on how you build money. I think you build money very much like I guess the pyramids would have been built. I wasn't there, so I don't know, but I think it was done one block at a time, one day at a time, 1 week at a time. And you can build phenomenal buildings, and you can build, really good wealth, but you do it, day by day, brick by brick, with a huge long-term focus. And you really have to forget about what's going to happen from day to day. I mean, we don't even know what Trump is going to say tomorrow, and focusing on that as a way of making money is just not sensible.
Okay, you talk about aiming for a balance between reward and risk. And I just know, because I know you, Warren, that you're going to start off with diversification here.
So true. We when we look at investments and you ask someone, how much growth would you like? They would say to you, okay, I'd like to double my money every 3 years. I'm a reasonable person. Surely that's not a difficult target. And if that's a target, I would probably gulp if someone says that to me. But the next thing to ask them is, if that's your target, are you prepared to live with an investment that goes down by 60 or 70% over a 12-month period? Because if you're aiming for something that's going to double every 3 years, and almost nothing in the world will do that consistently, I promise you that. But if that's your goal, then it means you need to be prepared to lose more than half of your money over a 12-month period. And that starting point is critical for investors to understand. If you're just going for maximum risk all the time, maximum growth, that's fine. It's a bit like saying, well, I'm going to build a racing car and I'm going to put no brakes, no suspension, and nothing that makes it go around corners or slows down. I'm just going to make sure it goes as fast as possible. And I think we all know how that story is going to end. And so getting that balance between the growth that you would like, so the reward, and the risk that you need to take to get that reward, starts with making sure you've got the right combination of cash, bonds, property, shares, and that you've got a good combination of different geographies. You can't just invest all your money in the US, for example, because you think that that's the home of the new big, tech businesses that will take over the AI world. The reality is that they might do that, but at the same time, there might be some great biotech companies sitting in Korea and some phenomenal industrial businesses sitting in India and possibly still some good companies left in the UK. I don't know of any, but there might be. And then all through Europe. And so you need to have a good spread of companies and countries and investments to make sure you get that spread between risk and reward correct.
You also obviously need to, have proper asset allocation. So you need to look at different asset classes. What basis do you judge them or assess them, rather?
Your time frame here is your absolute ally in this decision. So if you're going to invest money for a 3-year period, because that's what you need to do to save money to get a deposit on a house, you absolutely can't go in and put that money into the stock market, even if it's a beautifully diversified index or a diversified global equity unit trust or anything like that. And the reason is simple, that the stock market's a great place for long-term growth. What you need to do when you've got a very short period of time, and 1 to 3 years is a short period, and you've got a finite goal. In other words, you need to have whatever it is, R1 million in 3 years' time for a deposit on a house. Then you can't afford to lose any money in a stock market correction. So your asset allocation, and really that's that combination of cash, bonds, property, and shares. That decision is largely determined by how long you need to invest that money for. And then secondly, your psychological tolerance for risk. Are you going to freak out if you see your investments go down by 5% over a year? Because if you are going to freak out, then that means you can't have too much in shares. And then the last factor will be your financial ability to deal with risk. If you're investing some money and you've got resources in emergency funds, you've got access to other money if you need it, that means you've got the capacity to take a lot of risk. And those are the 3 kind of broad factors that you would use to determine your asset allocation. But critically, your time horizon, I think, is the one factor that overrides everything. Longer term, you can afford more risk. Shorter term, you need to take the risk off the table and be much more cautious with your investments.
How often do you need to look at this? There's another word, rebalancing. How often do you need to do that?
I would feel comfortable doing that in every year. I don't think you need to do it more frequently. And I think if you do it too infrequently, let's say you only do it every 5 years, there's a very good chance that the very strong growing assets that you've got in your portfolio might have moved the whole mix of assets completely out of line. In other words, you could have far too much exposed to shares, far too little in bonds, property companies, and cash. And that might not be a bad thing when your shares are doing well. But if you're trying to manage the risk as well, then chasing the returns, in other words, letting those shares become too big in your portfolio means that you're setting yourself up for a disaster when the stock market does take a hiding. And we don't know if that's going to happen tomorrow or in 7 years' time. And so because we don't know, and no one does, making sure that the mix of your assets is correct at least once a year, and maybe do it at the same month every year, is probably sufficient to make sure that you've got that the right spread of assets, Stephen.
I mean, also, when you do this, you've got to really kind of, I suppose, smell the wind a little bit. But you shouldn't just react quickly. You need to sort of make sure you stick to your timetable. You don't suddenly, because you don't like this, get out of that. You've got to think about it quite carefully and quite soberly, and give yourself some time for it.
I agree 100%. And I think also resist the urge of FOMO, the fear of missing out. Because I think we need to know that, what we get told, whether it's in social media or by our friends, about how investments work or what's doing well or what people think is going to do well, and potentially also what they think is going to be a disaster. All of those are simple opinions, and they might be very eloquently positioned, and you might, it might be an incredibly intelligent person who's extremely well read and knowledgeable giving you an opinion, but they are forecasting. In other words, they're trying to predict the weather. It's as reliable as that. We can come up with very eloquent arguments about why AI-driven shares will be amazing in a decade's time, and equally, we could say that they're all overpriced and they're all going to fall over, and there'll be a bunch of other new companies that will do much better. The truth is, we don't know. So don't get too distracted. Build your portfolio and your asset mix and your objectives around yourself and what you need to do, and then don't worry too much about what everyone else is telling you they're doing and what the world tells you to do with your money. They don't need to live with the consequences if it doesn't go well.
Controlling your costs, because, sometimes investing this can be, there is a cost to it. It shouldn't be that expensive. But sometimes people will also talk about sort of free investments.
Yeah, I think we've seen in the last while, two very well-known platforms in South Africa significantly bumping up their fees, and they'd built themselves a reputation on being extremely low cost, and some of us were wondering how on earth they would be able to survive as businesses with the cost that they were charging, and surprise, surprise, the costs have gone up, and so I think understanding that if you're going to choose high quality investments, and by high quality I don't just mean what it buys, but also is there a good administration, is there good risk control from a fraud protection point of view, do you get proper tax statements and proper reports and access to your information. All of those things characterize high quality investments. And if that is the case and you want to buy high quality investments, make peace with the fact that they will carry some costs. And I think some costs are reasonable. You want to know that if you're making a long-term investment, that it's going to be around in a decade or two when you need the money. And so you don't want a nasty surprise where suddenly your costs jump up by 50%, or that the company ends because it wasn't ever sustainable. So I think be careful of very low cost or free investments. Sometimes a free investment could be a scam. Yeah, and that's something you've got to be careful of. And so if someone says to you, this is a high quality investment and it's free, you need to ask some serious questions, because it probably means you just don't understand what the costs are. So I think be happy to pay some fees. It provides longevity to your investments, but surely don't go and buy things that cost you 3 or 4% a year. That's ridiculous, and it's destroying the potential growth of your long-term future capital.
You've got to look at tax. You do have tax implications. You're getting an income, you're getting money from these investments. How do you manage that?
I think it's being careful that you don't overly focus on tax first. So not one of us ever wants to pay more tax than we have to, and certainly it's our constitutional right to pay the maximum that we must, but also the minimum we're allowed. And so make sure that you are tax efficient with your investments, but you don't want to get an over focus on saving tax. In other words, someone comes to you and says, here's this new structure, it's going to last for 5 years, you're going to pay me 5% a year because I'm the person putting it together for you, but gee, you're never going to pay tax on that. That's no good. what you're doing is paying some product pusher a huge amount of money to sell you a very tax efficient investment that's probably going to generate no growth. And if you don't want to pay tax on an investment that that doesn't generate growth, why don't you just go to the casino? It gives you the same job. So you don't want to avoid tax if you're in a position where you can actually generate good growth and pay some tax. That's okay. But I think a lot of people, especially older people, as they get later on in life, they start fixating on estate duty, for example, and then they start making really silly investment decisions because they want to avoid estate duty, and potentially end up leaving their beneficiaries a lot less money than they could have. And so I think be careful of that. The tax efficient vehicles that are really good for us, that are healthy, are tax-free savings accounts and low-cost retirement funds. Those are good ways to save and avoid tax, but be careful of structures that are complex, that lock you in and charge you high fees. Those are just a waste of your time.
We're speaking to Warren Ingram tonight, of course, co-founder at Galileo Capital in personal finance. We have a question for you, Warren. It comes from Kim. Kim says, I'm in my 60s. I have some extra savings I won't need in my lifetime. Both of my adult children have recently bought homes. They've got young children and at school. Is it a good idea to give them some of my money now? I do want to help them, but I don't want to run out of money myself. And I think there are people in this position. Is it an early inheritance? What if you then need it? Becomes the question. Well, we'll have the view from Warren in just a moment. Also, your questions for Warren on 011 883 0702 and 021 446 0567.
The Money Show.
Personal Finance with Warren Ingram.
Warren, we're going to get to Kim's question in a moment. First, we have Anne on the line from Sandton. Anne, hi. You have a question about retirement money in an RA, I presume a retirement annuity. Anne, good evening. Go for it.
Good evening. Thank you very much. Yes, I was persuaded. I had 800,000 rand left to live on until the end of my life, and I was persuaded to put it into an annuity with Liberty Life, which gives me approximately 8,500 rand a month for the rest of my life. Was this a good thing to do?
It's an interesting question, and thank you, Warren. Was it a good thing to do?
It's a tricky one, and I think understanding that when you've got very limited money left, and you can use the remaining money to buy an annuity. They're usually called life annuities or compulsory annuities, where it at least guarantees that you get some kind of an income for the balance of your life, especially if there is an element of inflation growth in that every year. So they'll give you a bit of an increase. Then very often, that can be a good call. The trick there is to make sure that you're getting a very good deal, and often people who, one of the things that the insurance companies will do is that they will ask you a whole bunch of health questions. And if it seems like you're going to live for a very long time, then guess what? They're going to give you a lower income. If you're not healthy or you don't have longevity in your family history, then they might actually give you a higher income. And then your job is to live as long as possible because you win. So I think looking at these life annuities, if you've got a very small amount of money left in your retirement funds, it is certainly worthwhile, especially when interest rates are high. But gee, you've got to do your homework very carefully. I don't think it's a one size fits all answer, Stephen.
Yeah, and Anna, not an easy situation, I'm afraid, for you.
Can I ask a question?
Yeah.
I was given a flat rate on 800,000 rand a month of 8,500. Sorry, a flat rate of 800,000 rand. I was given. I'm getting 8,500 rand every month.
Yeah.
There was no question about my health or anything. Somebody did it for me, and I am not existing on,
I'm sure,
8,500 rand a month.
All right, and thank you. Obviously, Warren, there'll need to be a lot more investigation into all of this, but it's also a reminder of how careful you need to be with these policies.
Yeah, and I think it's a very the very difficult thing there is no inflation protection. So if it was, I just wanted to check, Anne, was it 8,500 a month?
Anne's gone, but I am presuming that was the case. She was receiving 8,500 rand a month on an investment of 800,000 rand.
So just to give you an idea, Stephen, that was that works out at just under 13% a year, as an income on that amount of capital. So if you take that 8,500, you times it by 12, and you make that a percentage of the 800,000, it works out at 12.75, which is way higher than what a lot of people would get, for example, if they put their money in a bank account or the RSA retail savings bonds, and those also don't go up with inflation, and actually when interest rates go down, they might go down. So it's a very difficult situation Anne's in, but it actually doesn't sound like she's ended up in the worst situation. I think it's probably making the best of a very tough situation.
Okay, no, that does make sense. All right, to Kim's question, I'm in my 60s. I have some extra savings I won't need. My adult children have bought homes. They've got young children. Is it a good idea to give them some of the money now? I want to help them. I don't want to run out of money myself. Kim's got an interesting question. Got an interesting problem.
I think it's an amazing thing to do, and there have been studies that have been done about this topic all around the world, including South Africa. And if you've got adult children who are responsible with money and they're not just blowing it, and in this instance, it seems like they've bought houses. That doesn't sound irresponsible to me. Then giving them some capital in while they need it most has a huge impact on their quality of life, their ability to look after their own children, and it almost works out sort of 1 to 2. So giving someone 2 million rand when you die in your let's say you're age 85 and they're 65, or giving them 500,000 rand now, it ends up being about the same. So I think giving them the access to the money now makes a lot of sense and will be life changing for them. It also allows you to see the benefit of that money actually really making their lives better. And I think it's very rewarding for parents who are capable of doing that. There is obviously a huge caveat and that is, please don't give away too much and get into the position where you run out of money. So some of the money, especially if it's a loan or a home loan, for example, is the one solution is you can sign a loan agreement with your children to say, I will lend you this money. On my death, it will become part of my estate, and then you will inherit it. But in the meantime, I will give it to you as a loan, and my plan is never to draw on that loan unless I run out of money. So you can set up a legal agreement between yourselves and your kids. I think it's a very good idea because you want to be very careful of donations tax. Just as a reminder, you're allowed to make donations of up to 100,000 rand a year. Anything over that, you start to incur donations tax. So doing this as loans to your children on the basis that you don't expect them to pay it back immediately, and you can give them a fairly friendly interest rate might be better, or you can decide to start actually giving them the money and paying donations tax. That might be an option for some people, but certainly if it's below 100,000, you can donate 100,000 a year. And if Kim's married, her and her husband can both do 100,000 to each child. And that's a very nice way of doing this very efficiently from a tax perspective.
Okay, now that makes a lot of sense. And then very quickly, this is all about time.
You have a superpower, all of us as individuals. We're not tiptoeing around what fund managers and institutions are doing, having to perform and show our results every month or every quarter or every year. We're in this for our lifetimes. And so that means that you don't need to make decisions based on short-term movements or what the boss says. You can do this for yourself. And that gives you a huge advantage over everyone else who's operating from day to day or week to week. So use time as your superpower and focus on the long term, and please ignore the short term.
Warren Ingram, thank you very much indeed. Good advice, especially this evening. Warren, of course, is a co-founder at Galileo Capital and a certified financial planner. He'll be back next week.
You're listening to The Money Show with Stephen Grootes, brought to you by Absa Corporate and Investment Banking. proud sponsor of the African Mining Indaba 2025.
Well, that's it for the Money Show today. What will tomorrow bring? Look to Washington and see. It's just gone 8 o'clock.